Greetings, everyone. Welcome to Master of Crypto, the technical analysis aspect. Technical analysis is very important for identifying trading opportunities in the market. But what you need the most to survive as a trader is your mindset, having a winning mindset, not being afraid of the market, not being overconfident, and not being too greedy. So in today's class, I want us to look at chart patterns. Chart patterns. There are different types of chart patterns, and they tell us different things in the market. We'll start with looking at what is called M's, and the opposite of M is W. So this is double top and double bottom. Double top, one top, second top. Double bottom, one bottom, second bottom. Now, if you look all over your chart, you will see a lot of these patterns. In fact, almost everywhere. Just by looking here, I can see this is a double bottom. This is another small double bottom. This pushed up. This is a double bottom, a small double bottom here. This pushed up. This is forming a bottom. I won't be surprised if it goes up, forms another bottom, shoots up. So that's how prices move. In moving down to, you see this is an M, comes down, pushes higher again, comes down, gives you another small M, another M, pushes down. So prices, you see a lot of these double bottoms and double tops in the course of your trading. Now, double top is a bearish pattern. Double bottom is a bullish pattern. Now, double top M means that price is forming some form of resistance. It's an area of resistance, and there's a high likelihood that it will sell. Double bottom means price has gotten to an area of support, and there's a very likelihood it might push higher. It means that those who are buying are defending this price level. They are saying there's a lot of value here. So once it comes back here, let's buy. Now, there are different variations of double top. You can have an M that is like this, a normal M that has equal tops, meaning the two tops are the same level. You can have an M that looks like this, that has a lower top, a second lower top. This top is lower than this top. It's still an M. You will have another one that is like this. The other M goes much higher for coming up, but it's still an M. This is higher, is lower than this, but it's still an M. Now, you have the opposite for double bottoms. The opposite too can happen. You have the normal one. You have one with a lower leg, like you see here. This is a perfect one with a lower leg. This one too has a lower leg compared to this. This one has equal levels. Then you have another one that will be something like this. Then you have a deeper leg before it pushes up. Now, those are the different types. Now, how do you trade them? If price is an area of resistance, let's say, okay, let's start with the double bottom. If price is at an area that you identify as an area of support, especially a key level, it is actually even more powerful if one leg of the W started on a particular day, let's say started on the 30th, then the second leg forms on the 31st. So you call this a multi-day W. It happened within 2 trading days. It means that this day buyer prices came down, buyers pushed it up, sellers pushed it down, but then now price got near the previous day's low. Now buyers are looking to push it higher. These ones are very perfect. Like you see here too, a similar thing happened here. Now, how do you trade W's? There are two ways to trade them: the conservative way and the aggressive way. Now, we'll start with the aggressive way. When you see the first leg, price comes down like this, goes up, comes to the next level of support, near support. You are waiting for what is called a trigger candle. What is a trigger candle? A trigger candle is a candle that tells you that, okay, if you are looking to buy, then strength is coming in for the buy. And some of the trigger candles are bullish engulfing, or a hammer, or what is called a morning star. Now, let me show you. All those candles are here. This is a bullish engulfing candle. This long one here is a bullish engulfing candle. Then if you, these two here, 1, 2, these are called tweezer bottoms. These two, 1, 2, okay, let me expand. So this is called a bullish engulfing. Why? It engulfed all these candles that are here. It engulfed all these candles that are here. Engulfed this one. So this is a bullish engulfing. It shows there's a lot of strength. But even before this bullish engulfing formed, somebody who's looking at this W bottom would have bought around here. Why? This is a sign of a reversal. Then another thing, you can look at H4. Okay, these are the areas we're looking at. Yes. You can look at H4. What happened on H4? See this strong candle. You buy on this candle. So now this is your double bottom. But if you go to H1, you see that the double bottom is clearer because it's wider. Okay, see it here. It's wider. So that's one way to trade it. So if you buy here, you are trading aggressively. You're trading aggressively. And trading aggressively sometimes has more risk than trading conservatively. Now, if you start seeing this candle, maybe you buy here or you buy here. If you buy here, you put your stop loss somewhere below here or somewhere below this previous L. But a good place will be here. Then you take your first day profit. Then of course you target above. Then that's aggressive. Then to be conservative, you identify what is called the neckline of the M. Now, if this is of the W, if this is the W, this area where it formed this push up is called the neckline, this area. So right here now, this area will be our neckline. So you have a W. So this neckline. So for those who are conservative means they are not rushing, they are just waiting for a very clear signal before they enter. So for the conservative guys, they'll want to wait for price to break above the neckline, which happened on this candle. So that's when the conservative guys will buy and put their stop loss maybe somewhere here or even below this place. They are very conservative. They are sure that price has broken this level. So even with the retracement, they can stay in the trade and expect a push up. Now that's for the W and how to trade it. Also, if you are using an indicator like an oscillator RSI, which I do, this is the RSI I use, it's like an RSI, you will see that, okay, let me not do this today. I don't want to talk about indicators yet. Okay, now let's look at the double M, the M, and how to trade it. Now, this is M. Now, this is your neckline, somewhere around here. I'll now tell you why the conservative guys don't like entering their own M from the leg, from the start of the left leg. So when price goes up, gives you the aggressive guys enter here, put their stop loss here. But the conservative guys will wait until price breaks the neckline, which is here. Now, the reason they wait is this. Sometimes you see an M, you are expecting it to play out, but then what does it do? You see an M, you are expecting it to play out. So you sell here, expecting that, oh, this M will just keep going down. But what does it do? It gets to this place, and instead of forming an M, it starts showing you a W. It starts showing you that, oh, this could be a W. Can you see? So what you are seeing as M has suddenly now start looking as a W. So what do you now do? So for the conservative guys, what they do is when the M happens like this, they wait for a breakout. If there's no breakout, they don't sell. The reason is because what if they sell here? What if they sell here? Sorry. What if they sell here, then price comes here? Sorry, what if they sell here? Price comes here, then forms the W and pushes up and hits their stop loss. So that's why they wait for the breakout. So for the conservative guys, they'll wait for a breakout. So they would have entered that trade maybe here after this breakout. So now what happened? This M that we saw here now formed a complex M. Now this is a complex M. When you have an M that doesn't play out and gives you another up, you now have triple top. 1, 2, 3. So this triple top is now what is called a complex M, because the first M did not play out. Now another M started forming. So this is a complex M. So the same thing applies to complex W. An example is here. This is a complex W. You had W, then gave you another W. So this is a complex W. Why? Because you had the first one, 1, 2. You understand? That's a complex W. Now, there are other W's and M's that are complex too, but are slightly more complex or more complicated. They are called heads and shoulders or inverse heads and shoulders. They look like this. You have price. Let's do the inverse head and or let's look at the head and shoulders. Price forms, goes up to a resistance, comes down, goes up. You think it's going to form an M, but it goes very high, forms M with a higher left leg, then comes down. You think, oh, this M is finally going down, but then it gets to the neckline and bounces again. But this time around, it doesn't go high. It stops at this level, then pushes down. So this is a complex M, but it's referred to as head and shoulders pattern. So you have your head represented as H, then you have your left shoulder, shoulder, right shoulder. So how you trade this complex M is similar to how you trade the normal M. If you are aggressive, when you see this pattern, you wait for price to come to the left level of the left shoulder. When it comes here, you wait for a red candle or a sell candle that tells you, oh, this area is acting as a resistance. You sell here, then you hope that price will get here and break this neckline and keep going down. That's for aggressive. The conservative guys will wait for price. It has formed heads and shoulders, wait for price to come down and break this level, retest it, then that's when they will now sell here. Now let's look at it for the complex W. We just looked at the complex N. Let's look at the complex W. There's actually one. Okay, let's go to Bitcoin. There's actually one on Bitcoin last week. So let's come here. Okay, this is Bitcoin. See the one I'm talking about. This is a inverse head and shoulders. It's called inverse because it's like an opposite of the head and shoulders. Head and shoulders is like this. Have your neck, first leg, come down, up, down, up, down. This is your shoulders. Then the inverse head and shoulders is the other way. You have your first leg goes up, then a deeper leg goes up, then comes down, then shoots. So you have your head, shoulder, shoulder. So right now, we can see that pattern here. This, 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 this. So the aggressive guys like myself, I bought here that day and I called it on the group. So what happens? Pushed up, broke past the neckline, or you can do like this. So the conservative guys will wait for a break here. So when it goes up and comes down, that's when they will now buy because they are conservative. They want to be very, very sure before they take the trade. You know, so that's a heads and shoulders pattern, which is a complex M. All right.